Good morning, everybody. Thank you for inviting me for this conference. It's really a great pleasure for me to be here again. EBRD has a very long cooperation with the capital market institutions in this country. We had a couple of years ago a project with the Macedonian Stock Exchange to help them develop their business strategy. Now we are working with CSD here on similar issues to help them develop their business strategy. And of course, we are also heavily involved in the capital market integration project with the other exchanges in this region. But why I'm here today? Okay, let's try it. So why I'm here today is to talk about the equity public capital market, from the issuer perspective, because earlier this year we signed a memorandum of understanding with the Macedonian Stock Exchange to work together on building a pipeline of issuers for the equity market. So we are now looking for companies that can be eligible for a public capital market transaction, be it an equity or a bond issuance. And the reason why, the main goal of this presentation today, actually there are two main goals. First of all, to give you a teaser on this whole process, also to show the complexity of this whole process, but also to prove that this is not something that is achievable only for the big guys. It's not for the big companies, it is for the good companies, so the public capital market. And let me start. Okay. Yes. Okay. So let me start with a short case study, just to prove that what I said before. There was a company a couple of years ago in Latvia that is really a tiny capital market from the Baltics. Even among the three Baltic countries, it has the smallest capital market. And there was a company called Madara Cosmetics that had a successful IPO in 2017. And why I thought that it's important to bring this example here, because that IPO was extremely successful, but it was really tiny. The total transaction was around 3 million euro, so really not much. The company is also a small one, or the total capitalization was at that time 25 million euro. So that's not a huge company, and it was really on a very small market, but they managed to attract local institutional investors, local retail investors, and also international investors to that transaction with a quite clear and smart transaction, and also what was the most important thing, with a very good story. So here in North Macedonia, what we are looking for right now is what companies we are looking for. Well, there are four main factors that are important to have for a company that wants to go public. First of all, ambition. That's clearly the most important. The company owners needs to be very ambitious to grow the company further. The growth potential, of course, clearly, we need to build up a story for the investors. We need to be credible that the company has potential to grow further. And why the companies are turning to the capital market in such a situation? Because usually they don't have funding sources from other alternatives, most importantly from the banks. Why it can happen? Because, of course, there is the capital balance question. No company can have infinite opportunity to get credits, new loans. There's a certain limit that they cannot exceed, and that's the point when they need extra equity capital. Of course, growth can be financed from the profit of the company, but we all know that is very time-consuming. That can create only a slow growth for the company. And today, it's very difficult to be patient. And actually the market, the whole economy is not designed in a way that you can be patient, because what product offer you have today may be totally abandoned and obsolete tomorrow. So we need to take the opportunity as quick as possible. So these are the main factors what we are looking for. when we are searching for the companies. The very first mistake the companies make when they thinking about potential equity issuance, public equity issuance, is they try to compare the cost of the funding. But they compare it usually to the bank loans. That is the alternative for many of them. But that's really a bad, a huge mistake, because you cannot compare these two things. It's like comparing the apple with the banana. In case of the bank loan, the company gets the money only for a certain period of time, and the money should be given back to the bank. It has a price, of course, the interest payment, that's clear for everybody. In case of the equity issuance, public equity issuance, the company gets the money forever. How you can compare that with a bank loan? What is the price difference between such a money for a certain period of time and money forever? It's very difficult to justify. And there is another issue that needs to be taken into account. In case of a loan, the company owner is increasing the risk of their own risk, the owner's risk. They're leveraging the company's profitability. In case of equity issuance, actually the risk is decreased because the owner is sharing the risk with the new equity investors. So that's why you must not compare the cost of loans, the cost of equity issuance, because we all know that equity issuance, of course, much more expensive than a classic loan. But besides the capital that we can get on the public capital market, and I can say that the public capital market is, by definition, the infinite source of capital for the companies, there are many other reasons or benefits that a company can get through a public listing. Going public can bring many advantages for the company. First of all, with the publicly listed shares, the company gets a currency, a new currency that can be used for many purposes. First of all, that currency can be used to take over other companies. We can pay with the shares to another company. The shares can be used to remunerate the management, the company, the employees of the company. And that means it's a very good tool to save cash for the company. And there are other issues that's very difficult to of course, evaluate. That building the brand of the company, being in the club of the listed companies, that's a reputation, a much higher reputation for the company, especially if the company is going abroad to make business relations with foreign partners. That can be a game changer. And it also increases the reputation towards the employees. Working in a public listed company, it's not the same as working in a small limited company. So, and of course, all these factors are very difficult to evaluate, but definitely all these factors has value for the owners. So what is necessary to be successful on the capital market? First of all, of course, that's not a surprise. There should be a very clear and long-term vision. What the company wants to achieve, how the money will be used, that is raised through the capital market transaction, and how the company wants to use the capital market a longer term. Usually, the companies who are going public, the thinking concentrates always on the first transaction, and then many of them simply abandon the capital market, and they don't care at all what will happen later on. That's a bad strategy, because in that case, we immediately when we open the gate of the public capital market, we at the same time also close it, because a company that is not managed well on the public capital market can be easily a dormant investment opportunity for the investors, and any follow-up transactions will be very difficult. And investors like those stories where there is a chance and there is a clear path that first transaction will be followed by other transactions in the future, and there is a clear vision how the company will grow through and with the support of the capital market. The story, of course, that should be compelling, that's very clear. The third point what I want to highlight is, of course, that's one of the most important one for the investors, that's the governance structure. Because usually the investors are investing into the management, into the team that will achieve the goals. And how the company is managed, how the decision-making process is built up, that's very important for all the investors, especially as they give the money for the company forever, and of course they want guarantees and that the money will be spent properly and in a professional way. That's why, of course, the board structure, the involvement of independent directors is very important for all the financial investors. That can be, of course, a burden for the company, that's clear, and that's why many companies are afraid of that, because opening up the shareholding structure usually means opening up the decision-making process as well inside the company. The fourth one, that is many times forgotten, that is the trustworthiness. Of course, that cannot be judged immediately at the transaction, only a longer term. That's why it's very important for the company to be to deliver the promises. What does it mean? Of course, we can promise whatever we want during the transaction. We can draw a very bright picture on the company, but if we don't deliver those promises according to the statute, then it will be punished by the market participants. It's much better to promise less and deliver those promises instead of promise too much and then do not deliver at the end. So I'm pretty sure that it's clear now that it is much more than a financial transaction. And it's a very complex and long story. That's true. Preparing for an IPO, that can take at least 6 months or even more, dependent on the level of readiness of the company, especially in relation to the governance structure. Building up a professional management, that's time consuming. Especially for those companies that are more or less one-man shows, and the many smaller companies are managed like that. So changing that structure is really, really painful and time-consuming, but it definitely makes sense. And from that point, of course, the whole process can last again a couple of months, dependent on how fast we can select the proper advisors who will help the company through the process. And here we are talking about several types of advisors. First of all, the most important is the investment bank or the brokerage company that will manage the whole transaction. They will create the link between the company and the investors, so they are the most critical. They have the most critical part of this whole process. But the company will need legal advisor, also PR advisor, dependent on how the communication strategy is built up and who are the target investors. So it's really, really a burdensome exercise. We cannot hide it. There are some really key concerns or questions around the IPO that are usually raised by companies. First of all, of course, the pricing. What will be the price of the share? What is the price of my company? What is the value of my company? That is the million-dollar question for every single owner. The bad news, there is no single objective measurement of company valuation. Nothing like that. There are many models, complex ones, simple ones, but none of them have a clear single answer for that question because there is no absolute value of the company. The company value can be compared to other investment opportunities. That makes it very difficult. And when we are comparing to other investment opportunities, we try to find as similar as possible a company in the market, but we can't find, of course, because none of the companies are totally equal to another one. That's why all these valuations can be just a proxy. That's one thing. The other thing, that all valuation are done on our judgment on the future, because that's one thing what the company achieved in the past. Of course, that's okay, that's fact. All valuations are based on that, but all valuation has a special factor, that is the question, to what extent the past performance can be repeated in the future or even improved in the future. And for that, that judgment is, of course, a subjective one. And that judgment is based on the risk preference and risk perception of the investors. That is, again, totally different for every single investor. That's why every single investor has its own valuation. And of course, the company also has its own valuation. The company owner has also its valuation. The last point, what makes it very difficult to have a joint, let's say, a common understanding on the valuation, is because the company owner always have much more information on the company than the investors. They know, the owner always knows everything. The company, investors have some information, but not on the same level, and that bring a discount rate on the investor side. What I can recommend to all issuers, potential issuers, that it doesn't make sense to start a debate on the valuation. You can accept the market valuation or you can refuse that, but it doesn't make sense to start a debate because of all these factors. The two sides are coming from totally different perspective. So the second question, issue that I usually raise, that okay, but why I'm listing on my securities on the local market? That's a tiny one. I would like to go to London. That's a liquid market, huge market. Everybody is there. I would like to go there. I can say that that's not the case. A company, a North Macedonian company, will always be always perform better on the local market than in London. That's a fact. Why? Because here all markets are strongly reliant on the local investor base. That's very important. Even we are thinking that all the financial sector is highly professional and very efficient, but this home bias is still there. A German investor invests in German companies. A UK investor invests in the UK companies. North Macedonian investors will invest first of all in the North Macedonian market. And that's a North Macedonian company will never get that attention in London that can get in the local market. That's very important. That's why, of course, 9 out of 10 companies around the world are listed on the local market. Be it a small market or a large market, that's the same. It is very important that the main question is, of course, whether foreign investors can have access to the local market. And that's the main task of the capital market infrastructure, to make it as easy as possible for the foreign investors to access the local capital market. That's clear. Because, but from that point, the investors will not care whether it is listed on the local or in the international market. So the next question, do I need to care about the secondary market performance? That's another mistake that company owners usually make, that they take a look at the price performance every single day. That's the better case. Maybe they can do that several times in a day. That's really the bad approach. There are many factors that influence the price performance of the company. And the company can influence only the fundamental value of the company. All the others are totally out of the control of the management. It doesn't make sense to take a look at those factors, but the good management does if it concentrates only on delivering the company strategy. And that strategy, of course, not a short term, but a long term. And the last question is about transparency. There is a major fear that for a public listed company, transparency means that the company needs to publish every simple information about the company, even business secrets. And that can be harmful with the competitors, and that's why they don't like this whole idea. Well, there is a general rule, of course, that all information should be disclosed by the company that can have an effect on an investment decision, can have a price influence. That's the general rule, but it has a second part, this sentence, that unless this information cannot be kept under control, cannot keep inside their group, in the management, for example. If we cannot ensure that control, then of course we need to publish the information as soon as possible. But if we can do that, that's not a problem. Having an insider information, that's not against the law. Using the insider information for trading, that's against the law. That's a huge difference that needs to take into account. So it's not something that you need to be afraid of. That's something you need to build into your thinking, into your communication strategy. So that's all in a nutshell. Of course, that was really just a teaser, and there are many, many other questions, but I hope that at least I managed to bring it closer to everybody. And of course, I am here for the whole day, and if you have any questions, I'm happy to answer them.